Good afternoon and happy Friday to you, DGI investors. It's Colby, the DGI Crab, coming to you with my end of the week video where we're going to take a look at the 4-tier spreadsheet, see if there have been any changes from the past week, and see what kind of value that we may have going into the markets next week. So think we're all this month just kind of sitting back and waiting to see if and when the Federal Reserve is going to cut interest rates. One would think that the stock market would react positively to rate cuts. We've had a jobs report come out today. Market didn't particularly care for it, and it went down a bit, but we're still overall looking pretty good for the year in terms of where the market is sitting at. So we're going to take a look at a few things today before jumping into the spreadsheet. But before I do any of that, I will say I'm not a licensed professional. Nothing in this video should be construed as investment advice. I'm simply sharing my personal strategy and providing you some food for thought for your own investment journey. All right, everyone. So first, I wanted to just take a quick review of the S&P 500, just so we can, again, keep things in perspective. On the day, down 1.67%, and over the past trading week, down nearly 3.5% from where we were last week. That seems like bad news. But if you just zoom out a little bit to the 1 month chart, we're up 3.5% overall still. On the 6 month chart, up 6.5%. Year to date, still up 15.63%. So that is a great year for the market. If this was the end of the year, just theoretically, this would be a really good year for the stock market. The S&P 500, since its inception, averages about 11% growth per year. We're sitting at 15.63%, even after kind of a rough day, rough week in the market. So just keep that perspective. We are in a very, very hot stock market still. This thing has a long way to fall before we get anywhere near being negative on the year. It's got a little ways to fall before we even get to the point where we're below the 11% average growth rate that the S&P 500 has. So always want to remind you all of that. Just keep that in mind. And it's been tough these past few weeks to find quality value on the DGI Crab 60 stock list. So if you're new to the channel, just a quick rundown here. This channel focuses on 60 and only 60 high quality dividend growth stocks with a long history of increasing their dividends. I took those 60 stocks, split them into 4 separate categories or tiers that are based on the age of the investor. So we're going to go through each of the 4 tiers, and what we're focusing on here and sorting by is the valuation column here, which is the average 4-year average yield compared to today's current day yield, and how big of a discrepancy there is between the two. Anything that the yield is 30% or more higher than the 4-year average yield is in the green category. If it's 20 to 29%, it's in the yellow, and everything under 20% is in the red. I don't sell anything that's in the red. I'm not a stock trader, but anything that I own that's in the red, I'm just sitting and letting the drip or the dividend reinvestment do the heavy lifting for me. And any new money I'm adding to the market is going into stuff primarily in the green categories. Maybe in certain exceptions, I might invest in something that's in the yellow, but I really want to invest in stuff that's in the green category based on my age. So tier 1, these are compounders for the 18 to 30-year-old investors. What you'll see with these is that cumulatively their average yield is going to be probably in about the mid-ones as a group, but the year-over-year dividend growth rate is going to be in the 12% range. So what we want with these is to accumulate these when you're young, when you don't have a ton of money in the market just yet, you're just kind of starting out and building up that portfolio. You want to establish positions like these that are going to grow their dividend payout well above 10% year in and year out. So that way, when you continue to grow older, you get into your 30s, your 40s, your 50s, this chunk of income that you establish is going to rapidly increase and snowball into something very, very impressive. Nike and Nordson remain the two stocks in this tier that are in that green buy zone. Nike remains the most undervalued stock of all 60 of the stocks the channel covers. It has recovered back up into the 80s. It got up into the mid 80s there for a bit, but most things have fallen over the course of this week, and Nike is no exception to the rule. I'm still liking that starting yield way up here in the high ones. It's usually something that yields just a tick above 1%. So we're getting this at a starting yield far higher than we typically would get. And then Nordson still looking strong here with a 1.28% yield when the 4-year average is under 1%. So you can get a couple of serious dividend compounders here. Very undervalued. Tier 2 are stocks for the 31 to 41-year-old investors. This is the tier that I am in, at least for the next year plus. We have Hershey and Target remain our top two on this one, same as last week. Hershey under $200 still is a remarkable value if you ask me, and I continue to focus very heavily on Hershey. I will just tell you, I waited several years for Hershey to get into the buy zone. It was overpriced for a very long time. Now, I know this channel doesn't go back a couple of years, so you're going to have to take my word on it. But if you go back and look at the charts on Hershey, getting it to yield this high up in the high twos has not been something that's been a common occurrence up until just about 2024. So I'm very excited to continue to add Hershey. And Target still looks pretty strong here, just a hair below 3% on the yield. It's been trying to recover this year. It's been as low as the 130s at certain points during the year. But even here at 151, still looks pretty solid. American States Water is edging back up into the buy zone. It has been free and clear of the buy zone now for the last several weeks, but it's getting closer. If it dips down here below 80, down into the high to mid 70s, then we'll be swooping right back in and buying American States Water, the company with the longest consecutive dividend increase streak history on the entire stock market, closing in on 70 years of consecutive dividend increases. Tier 3 for the age 42 to 53-year-old investors. Again, you're still looking at the same two here as well. Archer Daniels Midland and Hormel Foods have been sort of switching back and forth between the two, but they're both just about equally undervalued if you ask me. Hey, leave me a comment below if anyone snagged Hormel a couple of days ago this week. I believe that was on Wednesday. It's either Wednesday or Thursday. Hormel very, very briefly dipped below $30. And what an amazing buying opportunity that would have been if anyone was paying attention to that. It shot right back up above 32 over the last couple of days after that. But let me know if you were paying very close attention to the market that day and you grabbed you some Hormel down there at like $29.95 or heck, even $30.05, somewhere in that range. Let me know, because good looking out, good purchase there if you did do that. And T. Rowe Price, hey, we've been looking at this one for the last few weeks, watching it get closer and closer to that buy zone. It is almost there. Current yield is pushing 5% on T. Rowe Price. If I can get that under $100, I'm going to be really happy with that. It's just been a rough go for the last 18 months or so for T. Rowe Price. This 4-year average yield, if I'd have been doing this 24 months ago, this 4-year average yield would be a lot closer to 3% than 4%. But it's just stayed down for a very long time. But nothing has changed for me in terms of how great of a company that it is. Still think that it's a fine stock and one that's certainly worth owning. But I am going to wait on it to get just a little bit cheaper. Tier 4 for the 54 and older investors that are looking to add income immediately. Main Street Capital is starting to come down a bit. It's been up above 50 for a while now. It's the best one here in terms of value. I think if the Fed is going to cut interest rates, business development companies like Main and Ares Capital Corporation are probably, just a guess, but I think you're probably going to suffer in share price. So we may have some good value for this group in that BDC category if and when the Fed does start cutting interest rates. We'll just have to see. Every week I do take a quick swing by the top 10 tab. So this is not a new collection of stocks here. These are just simply my 10 personal favorite individual stocks. If I could only have 10 stocks in my portfolio, this would be the collection of 10 that I would keep. If any of these stocks get into that yellow category of 20% undervalued, that they are in the buy zone for me. I don't wait for them to get to 30% or more because they honestly seldom ever do. These are the bluest of the blue chips. Nothing here looks to be even remotely on sale. Pepsi and Johnson & Johnson are maybe reasonably priced right now, but I'm staying away from all 10 as of right now. Love all 10 of the companies, but they got to be a little bit cheaper than this. And hey, listen, the stock market took a pounding this week. These 10 stocks really didn't. They're just that good. So if we look at the strategy here for the week for the investor, I always will stand on the belief that when you're adding new money into your portfolio, you ought to put at least 50% of your money into ETFs so you get automatic diversification and you're not trying to necessarily time the market with your ETFs. Now, for the tier 1 investor, I usually would say about 25% into the S&P 500, 15% into a small cap, 5% into a dividend growth oriented fund, and 5% into an international fund, in which, by the way, VYMI is at a 5% for each of the tiers. It's my favorite international ETF by far. And then for the individual stock positions for the tier 1s, Nike's the most undervalued, so I do about 30% Nike and then a 20% into Nordson. Tier 2, kind of same 4 ETFs here, and you could swap out a similar ETF if you've got one that you like more, but dividend appreciation would be 25%, the S&P 500 down to 15, small cap 5, international 5. And this is what I did this week for my tier, 25% Hershey, 15% Target. And anytime a stock is 50% overvalued or more, I think you can grab it regardless of what tier that you're in, and Nike fits the bill, so I did 10% into Nike. Tier 3, you want to go higher yield dividend ETF, so VYM, SCHD, DHS. Those are my top 3 for that category. You could split it out over all 3 of them, or you could do all into one, but I think that's about where 45% of the money should go. Archer Daniels Midland, a slight edge over Hormel here at 25 and 20. And then I'd do a 5% down into Nike and continue to try to build up a little bit into that position, even in the tier 3 age range. Finally, for tier 4, I did switch it up, you guys. Earlier this week, I did a video going over SPYI, a covered call strategy ETF that yields around 12%, and I decided to pull the trigger on it and add it to the tier 4 group. SPYD would be my stock-centered ETF, the 80 highest yielding stocks in the S&P 500. And then these alternate investments like high-yield bonds, preferred shares, MLPs, covered calls would round out the rest with 5% into all. And since there's not anything again in the tier 4s on sale, I would continue to double down on everything in this ETF category, with the exception of the international. I'd still keep the international at 5%, and I'd probably just dip down into the tier 3 and grab the highest yield or the best deal in the tier 3, which right now would be ADM. So that's the video again for the week, you guys. Be patient. We're going to find some other stocks eventually to purchase, but continue to buy those good ones when they're on sale. Nothing wrong with that. Check out the links to other videos in the description below, y'all, and I will see you next time.